Good morning and greetings, everybody. This is Jeff Scott, and this is my top-down review. Let me get to the first page. Come on, there we go. Slideshow. First of all, hope everybody is being safe and hunkering down in place, and that if you get coronavirus, you'll be one of those that get the mild case. Certainly is much more than I expected, but I think it's not necessarily the 138 deaths or so that we've had thus far, which is horrible. Again, we'll have 35,000 deaths from flu this year. It's the economic impact and the impact on lives of everything shutting down. Your servers at your restaurant, your cooks, the ones cleaning the dishes, the folks at the various stores that you used to shop at. I mean, this is impacting everybody around the country. So I really feel for them, and hopefully they'll get a government bailout or something soon that will help them get through the days. So hearts and prayers for those folks and for the healthcare workers on the front line. I called today stocks on sale is 50% off next. And then special word for my son, fear the FOMO. Fear the FOMO. Bear market rallies can be ferocious. They can suck you in, and what they do is they trap you in at a higher price and the market goes lower. If the next rally is the rally, if the next rally is a market reversal, you'll have plenty of time. We're down 30, 40% from where we started the year. You'll have plenty of time to get back into this market. You don't have to be the first in. Even the last in will do fine. As always, it's for educational purposes only. Anything I recommend are in the spirit of education, not investment advice. I'm a physician. I am independent. I pay for all my tools that I use. And trading involves risk, and you alone are solely responsible for any investment decisions you make. Options are especially risky, and when I talk about them, I'm assuming you have a basic knowledge of options, but I also suggest that you refer yourself to the Options Industry Council for their fine advice about why trading options can ruin your portfolio. Speaking of options, I've had a couple of calls of people ask me, well, what happens with your Scott Synthetic? Those who are new to me, a Scott Synthetic is basically a synthetic call, where I'm buying a call and selling a put at the same price, creating a synthetic stock, and then buying a put underneath the spread to protect my downside. If you look at the P&L curve, it's the same as a call. Well, I can do a synthetic put by buying a put and selling a call at the same strike price, which will be at a nominal cost, and then selling an out-of-the-money call, rather, in case the market goes against me. So it can be done. I've been doing more naked things than covered things. Oh, excuse me. My wife walked in at the most inopportune time. I'm not going to spend any time here except to say that I didn't learn this when I was born. I relied upon my tools and my knowledge. I'm a physician. I didn't practice medicine without going to med school. I didn't become a trader without getting educated. These are some of the sources. If you're not familiar with HGSI, the software tool, here is the website. I have no financial relationship there, except I'm, I guess, friends and family by being a supporter and doing volunteer customer support for over a decade. Free 30-day trial, no credit card required, and under investing strategies are hundreds of videos by myself, Ron Brown, and others. Well, we are clearly in stage 4 fear like I've never seen it before. This is the most rapid decline that we've seen in the market that I can find. Rapid and deepest decline. And last week was worse than, as bad as, or worse than the worst of 2008. So what does that mean? It means you should not be buying stocks or calls. These counter trend rallies are notoriously strong and tough to win at. You should be careful selling puts here or even doing bull put spreads because the market can drop much lower. Covered calls are fine on your positions, and I sold on an Apple position that I'm going to unload this week at the money calls last week because the premium was fat and it was a way to get me back closer to my cost. it went down quite a bit from there. So that shows you how stupid that was. Bear call spreads, selling a near-term call and buying one further out to protect your portfolio. They make sense in a market like this, especially after one of those rallies. Buying puts have become extremely expensive. So put spreads where you buy a put and sell a put out of the money can work. Selling calls, it's a naked strategy, so it's a risky perhaps. Shorting stock and then contra ETFs. So what have I been doing? I've been buying puts. I've been selling calls to pay for some of those puts. I have shorted with puts some stock. I've protected with put stock that I owned, and I've got a bunch of contra ETFs. Here's Friday's sector review, and just standing back and looking at it. It's not all red, but besides perhaps consumer staples here, maybe real estate over here, it's predominantly red as I look through it. If we want to look at the major markets, and we go into the regular Thinkorswim to look at that, sorry about that. Make sure we're on daily. Sometimes I mess that up. You can really get a sense of how bad this market is and how far we've fallen just by looking here. How long has it been since we saw the low of the year on the last day that we traded? Oh my goodness gracious. Look how far we've fallen in such a short period of time. 38, 33.97.50 down to 22.60 on the S&P futures. Do you see anything here that says it's done going down? I don't. Let's take a look at the NASDAQ futures. Maybe we want to argue that we're forming a base here. It's a wide and loose base, maybe. I'm not sure I believe that. If we look at the Dow futures, again, we had a few days that hit the same low. Maybe we're hitting the bottom there. I doubt it, but it's possible. The Russell futures, again, looks like we had a little bit of a pause, similar to the pause that we had up here, and we saw what happened. The VIX, I'm holding a bunch of VIX options, and I was trying to figure out why the market was down 900 points and the VIX options lost money. And I'm scratching my head, and then I figured out why. There was forced liquidation of a clearinghouse that did not have enough capital on Friday. That clearinghouse was heavy into buying volatility, which meant there was a bunch of volatility futures dumped on the market. And when supply increases and demand isn't there, price comes down. So we'll see if that reverses any on Monday. It would be great for the overall market for the VIX to come back down. And then the dollar has really rallied with the weakness in the market, although it softened up some on Friday. So you look at the market, it's hard to feel very bullish about anything there. And I'm certainly not feeling bullish internally. If I look at the weeklies, you can just see the damage that's been done, knifing through the 200 weekly, taking out the prior lows here from the 2018 December bottom, the Dow knifing through the Russell. I was hoping that the Russell was an outlier and that the NASDAQ would not necessarily come down this far, but I think the NASDAQ is just going to join the others and break through that 200-day. The VIX, big topping tail, but I think it was because of the forced liquidation, and the dollar had a strong week. Now let's look underneath. Here's the 10-year and the 30-year yields on the versus the S&P in yellow, and one can see that there was kind of just a little sideways move on both of these this week as yields started to perhaps steady, but at a rate that's well below what you want to see. The prices are clearly leading the AD lines down. I wouldn't say, like I have had a title before, the AD lines are leading lower. It's the price on both the small caps and the large caps. If I look at the NYSE, even the TLT turned up this week, but you could see just a dramatic pullback here. If we look at stocks above the 200-day moving average on the left and above the 40-day moving average on the right, this line here is a critical line. That's the lows touched in 2008. And guess what? We are as oversold right now, or almost oversold, as we were in late 2008. And we know the market became further oversold or fell further. If we look at the T2121, the 12-week new high, new low, you can see that we're not quite at the bottom line, but we're getting close to those levels that have only been touched a handful of times and usually signaled reversals. Now, something that I'm painfully aware of, and I used to say it when I gave speaking engagements, is we don't know, because I haven't gone back, but maybe I ought to now, and looked at bear markets and seeing whether or not getting oversold in the bear market causes big rebounds. What we saw in the bull market, getting overbought, did not cause big pullbacks. It caused some pauses and sideways moves, and then you went up further. I have a feeling that in a bear market, getting oversold causes a pause and a sideways move, and then you go down further, but we will see. The McClellan, look at the summation index and the oscillator on the daily, both getting to levels where you expect reversals. Weeklies are similar. This is going back to 2008, 2009, and we are just above those levels. The buckets. Well, last week on Thursday, we hit the all-time 99% below the midline of the Bollinger Bands, and 80% of the stocks in the S&P 1500 were below the bands. Now, that should have led to a massive rally. It led to little rallies and further down on the market, hence my thoughts that oversold in a bear market will be like overbought in a bull, and be more likely to be a sideways pause and then further falls. And you can see we're still very oversold, but off the bottom. There's no HINDY signals today, and I wouldn't expect any HINDY signals for a long time because they will not fire till we get to new highs. Market tone, this sort of surprised me when I saw some bullishness here. In the Russell and NASDAQ, it makes no sense to me. There's just extreme volatility, and perhaps that's impacting on this number, but it'll be interesting to see because it's a choppy pattern, and I guess maybe that reflects the one day up 800, next day down 1,200, next day up 1,000 activity. What a difficult market to have anything more than scalping short-term day trades. Sectors down across the board. Thank you, Cigar, for changing the way you did this. In magenta here you have one-day performance, in purple 2-day performance, and in this maroon you get the 5-day performance. And you can see here how over a 5-day window everything is down double digits except those consumer staples. If you want to feel the pain, you can look at discretionary down 24.7% and real estate down 26.3% over a 5-day period. If we look further out, you can see over a month, energy is down 57%. And look at these numbers. How would you expect your portfolio to be performing when the major market sectors are down 40 to 50% over the last 1 month? Canaries in the coal mine, again, showing the devastation in this market, broken down below the 200-day moving average. Nothing there that would suggest a bottom. Bigger picture, just want to make a comment about bear markets. We're at the average decline, or just about to the average decline. Average is average. That means you have some below and some higher. We can get much lower. Other comment is the median bear market 16 months. This comes from a presentation by Robert Schiller. And I wanted to also point out that the bear markets in red, including the Great Depression bear market, which we may be mimicking here, are deep and ferocious, but over a short period of time, this being the x-axis of time, followed by large bull markets over many, many years. So we are clearly setting up for one of these right now. The question is how long and how deep will it go? So can it get any lower? So I started by looking at, in this weekly chart of the Dow, which is the longest lasting index that I have access to. And I look back basically 60, 70 years. And during that period of time, these in green lines are the only episodes where the maximum downtrend or pullback was 30% or higher. I have listed these here, the date that they crossed the 30% threshold, which we are at now or exceeded in our market. Weeks from the high is how many weeks it took you to get here. So this 15 weeks here on the 1987, we're at 4, 5, 6 weeks at the most of a pullback. So rapid. From the point of where they were at today, how many more weeks until the low? You can see anywhere ranging from they're at the low in 87 and 70 to another 3 or closer to 4 to 5 months until they got to the low. So we may have another several weeks to go based upon history. And weeks to recover are listed here. That's 7 or 8 years here, right? 52 weeks in a year. This isn't going to get better overnight. Your portfolios are not going to get normal tomorrow. How about this one? This is the one that scares me the most, folks. If you Google Fred economic data, they have an option which is the ICE Bank of America U.S. high yield option adjusted spread, and it goes back to the 90s. So this is the data set that they had, and you could see with this brackets here, that's the full set. I drew a line here at about 9, and the reason why I drew it at 9 was there's been 3 periods of time, not 3 times, but 3 periods of time, late 2000, which lasted a couple of years, the 2008-2009 market crash, and then this week where this spread, this credit spread, popped its head above 9. The reason perhaps why I'm bearish, much more so than normal, and the reason perhaps why the U.S. Fed, have you noticed how fast they're acting, multiple things a day, multiple attempts at everything in their book, now trying to get permission to buy corporate bonds, why the U.S. Fed is acting as fast as they are. Let me show you some data. November 30th, 2000, it hit 9.06. By 11:30, oops, that's supposed to be a 2000, not a 2020. The S&P 500 had dropped 16.5% in 174 days. So it was already down 16.5% when these credit spreads popped their head above 9. What happened from here to the low? From November 30th, 2000 to the low, there was an additional 40% drop. So what does that signal tell me here? Well, right here, it sort of signaled that, geez, we're not done going down. All right, what about the next time? September 15, 2008, 9.05. By September 15, 2008, the S&P was down 26% in 233 trading days. Well, what happens afterwards? Well, we'll go from the same box. Whoops. Oh, there's a punchline. Same box to the low of the market in 2009. There was an additional 43% in 118 trading days. The good news is it's off a lower base, so it's a smaller number. What about today? March 20th, 2020, 9.82. We've fallen 32% in 22 days. Hence why I looked at 30% falls and why I'm talking about this. Anybody want to give me some money on the market going down? I'll take that money. No one knows where it's going. It's only 2 data points. This is the third in 20 years plus. I'm concerned about this market, folks. Been concerned. News and earnings. Boy, is that unemployment figure going to be a doozy this week? How far above 2 million is it going to go on the jobless claims? Look, I've done okay in life. Most of my family members are college educated, done well. I had 3 extended, not my immediate nuclear family members file for unemployment this week. I've never had a family member file for unemployment. One time that I can remember going back 40 years. And I have a very small family. This is hitting everybody and hitting every family. And I have a feeling it's got a long ways to go. I've never seen the economy shut down like this. Here's the news here. I don't think anything overshadows unemployment and the news that we don't know, which is what the Fed is going to do for additional stimulus and what fiscal stimulus we're going to see. I think that we need that money to go into the pockets of those waiters and drivers and cooks and cleaners, the lower middle class and the lower class that don't have the support. My wife and I don't expect and shouldn't get a check from the Fed. Hopefully that'll come soon, and that will help people because it's a very crazy time. Lots of earnings this week. It'll be overshadowed by the bigger news. Although if you look at CrowdStrike, that's one of my remaining positions and options, and it had great earnings and it had like a 15-18% move. They actually raised estimates. That's not been the story. So, historic sell-off steepens as worldwide economies shut down. U.S. major indices suffer the worst week, down from 12 to 17%. All sectors down on week as markets move further into bear territory. You can see the Dow and the Russell are below 30. The Russell's approaching 40% down in a very short period of time. And this is this year. You can only imagine what people's accounts look like. COVID-19 dominates our lives. Cases and deaths rising. Healthcare system from providers to institutions to staff in turmoil. What happens when a doctor gets sick? What happens when a doctor is diagnosed and everybody around them has to be on quarantine? States are beginning to shut down. Stay at home, shelter at home are in place. The masses are staying home as retail and restaurant industry shutters the doors, and entire industries, in addition, like airlines, hotel, casinos, cruise ships, are begging for bailouts. Based upon the numbers that I see, a bounce is likely imminent, but based upon the last several weeks, it will likely be large, fast, and over before we even know it occurs. Any rally is likely to be met by more selling. Bear market rallies are notorious and try to suck in the us little guys. I am well positioned with puts on my 2 significant remaining long equity positions, Amazon and Bank of America. I made a mistake with FOMO of buying some Apple, about 20% points higher than here. I sold calls against it almost at the same price I bought it because I was nervous, and I got like $17, $18 on the calls. They expire Friday, and I thought that I would do that because 17 or 18 bucks on 260 in 2 weeks was not a bad return. But I'm going to end up losing money on that trade. I have a large number of open positions on my favorite contra ETFs, SDS, FAS, VXX, SQQQ have been most of the ones I've been trading. I've learned some things. I've learned that doing vertical spreads isn't the smartest thing to do in a bear market because you get a nice return on your investment, but you cap your gains. And so I could have made a lot more money on a TQQQ short, but I put another one on and I made it a spread. Why would I make it the spread? Because the volatility is so high that the out-of-the-money puts, when I buy a put spread, for example, this is what I did this week. I bought an SDS at-the-money put, sold one $10 away. So this is like a 32, 42, 38, 48. Let me see if I can look it up on my phone while I'm talking, give you the exact numbers. Hold on one second. Here we go. Boy, I still got way too many positions. But a lot of these are short, so it doesn't matter. It's a 38. Let me get my number. 48, and I paid $1.15 for that spread. That spread allowed me to capture on a triple ETF that will go up if the S&P goes down. It would be a good return if the market falls. With the market rally, the short put dropped to 50 cents. So I just basically made a buck on the short put by covering the short put. Now I've got an open long put at 38, and I will see what the market does if I sell something against it to further lower my cost basis. But that has hurt me. I've had substantial losses like everybody else, mostly because I buy things when I shouldn't. And I balance the losses from that FOMO by winnings on my contra ETFs. These are designed not for investments, these contra ETFs, but short-term trades. All right. I could stop right here because I'm not going to tell you anything else you don't know. I think that that yield curve and the prior times it's occurred is enough for the money that you paid me for today. That's a joke. If I go into TradeStation, there's really not a whole lot to show you. I can look at the E-minis, and what you're going to see is we've got daily, weekly, monthly sells, and just deep, deep bars. This was the December 2000 lows of 2018. How far do we go? Do we go all the way down here, which I've heard some people talk, 2100, or do we go down to that magic 2000 number, which would be about approaching a 50% pullback? We'll see. We will definitely see. I guess 50% would be 1700. God forbid we go there. The NASDAQ futures, they all look the same. High jumps are low single digits. The Dow futures. Again, are we starting to give us evidence that we're going to have a base here? Well, we've done it before, and we drive right through it. The Russell futures, same story here. Actually, we're up a little bit on Friday, it looks like. If we go down and we look at the U.S. dollar, certainly been a place to be buying. Raising cash, a very good thing here. That's probably not good for the metals. Gold, which was 1700 for a heartbeat, is back below 1600, but gold has, that's the wrong one to hit, Jeffrey. Well, Emirates Airlines suspending all operations. It just gets better. And you can see the big sell-off in gold. You open up HGSI. Whenever I hear that sound in this market, that's not a good thing, but that was just about Emirates. Open up Major Markets Plus, and we're just going to look at an HGSI. I don't think this is going to be a long one. Like I said, you already got the most important stuff, which is beware FOMO. Beware FOMO. FOMO costs money. And as most of us with my hair color who've been doing this for a long time will tell you, you always have plenty of time to get back in. It's getting out that makes you the money.
Okay, I'll look at it. I'll look at it when we get off the phone, okay, son?
Boy, I wish there was a layout feature in HGSI that would always open up this way. It always takes me, it's not hard. It doesn't take me that long. I'm not bitching too much, George. Just it would be a lot easier. All right, so I've got a daily chart, weekly chart on the right. Before I go, look, we did have those Eurekas that we talked about last week, no more, and a kahuna last week, and that was on one of the upthrust. And then was that last week, Friday? Yeah, and then the market failed anyways. The bongos in red, clearly bearish feeling. The Hindenburgs, which fired before the market tanked, it still works. Here's the S&P 500. Again, are we starting to form a base? Time will tell. It hasn't worked in the past. In fact, if anything, this was sort of a ascending triangle in which is a bearish, or ascending wedge, which was bearish. All right, so this is the S&P 500. Not anything else for me to say that I haven't told already. Dow Jones Industrials, again, the same, bad. Russell 2000, bad. Again, up day on Friday. Hard to believe in this market. I think it was up. Let's see. Excuse me, it was down 2.3% because it traded higher, but was down 2.3%, which was the best performer on Friday. Not an up day. I take that back. And then the NASDAQ. Nothing to like there. I showed you the Canaries, which is not actively managed, but what about the 50, the Innovator IBD 50 Fund, ETF? They take in and out based upon what's in the IBD 50 on a weekly basis. Nope, not interesting there. What about the momentum tracker, breakout opportunities rather? Nope, not working. What about semiconductors? Semiconductors, we need them to lead a recovery. Nope. What about biotech? Lots of talk about biotech because of curing coronavirus. Nope. All right, what's working? I already showed you what's working more than anything else is cash. Cash is king. Look at the treasuries. Pull back a little bit on Friday, but still a bullish day. Down on Friday just a teeny bit. Big move over the last couple of weeks. Big whipsaw here. From a low the prior week at 24.6 to almost 29-ish. When does the dollar index have moves like that over a 2-week period of time? Again, the impact of the Fed, the current market and disruption, the crazy volatility. Speaking of volatility, we can take a quick look at the VIX, and you can see the VIX is extremely high. And again, I gave you the reason why I think it was down on Friday. Gold, you know, when you get worried, you buy it. When your fears come to reality, you sell it with everything else, and it came down, sitting close to support. This might be a period of time that gold starts to win, especially if the dollar calms down some. Silver, which has some industrial purposes as well, is dead or dying, and gold miners unfortunately look more like silver than they do like gold. What else would I want to show you? I think that's pretty much a run through the major markets. If I look at industry groups, you can see we have 175 groups. And if I go to 2 up, you can see that there actually were some groups that were up this week, and some of them are kind of interesting. Couple of things for those that have the person indicator I put in this is how many new buys in the index this week? How many new sells in the index this week? We're going to look at biotech because it had 21 new buys and no new sells. And then at the end of the week, what percentage index were in buys or sells, and the majority of them are sells. Look at entertainment bumped this week for reasons that we'll see in a second, yet everything's in a sell. So if we right-click on investment companies, change to investment industry group, you'll get a sense, first of all, nothing is as good as the index. That's a bad sign right away. And we just look at a couple of these. Yeah, they had big bounces. So this pattern here was probably 3 dominant patterns on my chart reviews this week. All right, pattern number 1 is stocks have been in a huge downtrend, and then they bounce. Now, what do I expect to happen here? I expect it to, if it's a bear market, to maybe run up a little bit more, sucker some people in, and then go back down. And I'll show you some charts that have done that. So this rapid bounce this week has been a very popular. Hun, could you turn my light on so I can have the fan? Has been a very popular response on some of the recovery stocks. Not necessarily a healing process, more of a bear market rally, but time will tell. You can see huge bottoming tails on the weekly, so maybe something will happen here. That was called, you got to be kidding me. No, I thought I said Canine. Canary Holdings, have no idea what they do. Here is Purple Innovations. What kind of companies are these? I've never heard of these companies. Here's let me go back here and bring this up. This might be helpful. 10% demand, a lot of demand here. You can see a bounce off the bottom. Are these companies you want to buy? AMCI Acquisition Group, that's an GBTC. Here is the number one group, folks, and the only thing that was happening there is they were bouncing off the bottom. Entertainment facilities. Again, nothing beat. Cedar Fair came out and gave some guidance, and here you got the pattern, a big move off the bottom. If anybody believes that the end is here, God bless you. You might want to buy this for a 20% dividend, but you wonder how often or how long they're going to keep dividend yields if they're losing money because of the slowdown in the marketplace. No, I'm not interested. Cinemark Holdings, most of our theaters are closed. Thank God I got a home theater. We've been watching a movie or a show every night. Not interested. Live Nation, well, they're canceling all the concerts. They're trying to get us to take credit. I want my money back when I buy my tickets. Marcus Corp. As I said, we don't need to look at a lot of charts today. Automobile Index. Bluebird. Don't they make buses? Again, a bounce and a buy signal. You got a lot of momentum there. Could be good. I'm doubting it, though, because of the market that we're in. That was above the index. Ferrari actually is another one of these, and you could see it ran right up to the 17-day and came right back down. I find it very difficult to want to go in and buy individual stocks. Biotech had a lot of new buys. So let's look at a couple of them. So this is Contrafect, CFRX. And the only thing good I can say about it is it didn't fall below its 200-day moving average. It's got lots of overhead supply. I'm not buying that. Doesn't make any money, no revenue. Syndax Pharma retook the 200. CRISPR, I made money on this in the past, had a nice trend there, then it had a bigger trend down. Still not excited. Phoenix, no. Arrowhead Pharma, this actually made my buy watch list. Why? I had to put something there. I'm kidding. It's got some revenue. It had a clear reversal candle on the weekly, but it's run into the 17-day. My expectations on it are not very high, but so far it was the best of the bunch because of the revenue. It's off its high by 62%. Cell Corp bounced off the 200, is now stalling at the 50. Again, this is what you expect. Endotherapeutics, this one had a big buzz, had a couple of updates at the end of the week. They're embroiled in narcotic litigation. Coherus is another one that I had interest in. Why? Because it's got earnings per share growth way above its multiple. It's a biosimilar producer for a drug called Neulasta, which was one of the most common used cancer drugs. It had a nice bounce, but again, how far is it going to go with this overhead supply? Twist, yeah, it had a big run up. It came down. I'm not interested. Loosey-goosey. Adaptive Biotech. Adverum. These are all dinky little companies. I can't find a whole lot more here besides tracking Coherus and Arrowhead. Casino gaming, yeah, I want to buy these today. They're all up because they're going to get a big check from the government. Now, Melco is a Macau gaming entity. So they're back in action. This would be the only one I might consider. It pays a 6% dividend yield. And I only consider it because it's mostly Macau. And eventually they're going to have some really weak comparisons. But if I look across the U.S., who's going to casinos now? Boyd? No. Churchill Downs, they delayed the Kentucky Derby. Ran up, gave most of it back. El Dorado, Caesars. When I see this topping tail, this tells me the stock opened up, gapped up. Everybody's excited, wants to get into this stock. Ran all the way up to the first line of resistance and failed. Not showing me a reason to be buying it. There's the index. It's just out of curiosity, look at when. Same thing. This, by the way, is the chandelier stop. It ran up to it, failed. Wow. Okay. These don't look too much interesting. What's the next one down? Oh, cruise lines. Sign me up. I'm being an asshole. I'm sorry. This is just crazy. This just tells you how bad this market is. Up on hope of bailout. No, we're going to become hospitals now. Carnival Corp. How can you buy these things? This is an industry. You know, Ackerman came out. He made some comments. Probably not all of them were appropriate. Carnival here. First one. Another Carnival, then the index. I don't know how these companies survive. I got a cruise with John Person out of Singapore in October. I just hope they give us our money back. Educational services, let's see. It didn't even make it. You know, maybe these are going to make sense both in China and the U.S. because kids are going to have to learn somewhere. China Online Educational Group, COE. It did not make my list. Why? Because it's got 100,000 shares traded. I can't trade something with 100,000. That said, it's got as good a chart as I've shown you. A buy signal off the 50, up again. The weekly bongo is green. This one looks like it could go higher. I don't buy things with 100,000 shares traded. Puxin, no. Aspect. 200,000, I don't buy that either. I don't buy, well, this one's closer. So the one that looked good, I couldn't buy because it doesn't have enough shares traded. Generic pharma, they're going to make all this hydroxychloroquine, except the Indians aren't going to ship to the U.S. Again, a failure, a one-day failure, hard for me to get excited here either. I wish I could show you great stocks. Not the market we're in. Infrastructure, I'll show you one. I bet CrowdStrike's at the top. Here it is. All right, so we'll go down and look at these. These are, a lot of these are security companies, and they're probably more important now as companies like mine have told their workers to work from home, take your laptops home, come in through the VPN. And since many of these companies have access to secure information, scammers may be trying to get in. Big move up here on Qualies, getting up to some major resistance. This might be good. Look at the positive convergence on the weekly and on the daily, lower lows, but not lower lows on PMC. I expect it to have some issues getting above the 50 and the 200, but a move above that, that might be interesting. Fortinet, less interesting. It failed at the 200 on Friday. Globalscape, no. Box, another thing about having people work from home is how do we securely share information? Is it OneDrive? Is it, which is free with Microsoft? Is it Dropbox? Is it Box? All these things are going to probably grow up because everything from elementary school kids to workers at home are going to be having to transfer documents. That's why it's had a nice little move. Convolt. Here's CrowdStrike. Now, does that look that exciting? No. Take a look at the weekly, a bullish engulfing pattern on the weekly chart. Look at the bullish convergence, even as it hit a new low. Lower low, not lower low much on the PMC, certainly higher than it was back here. It just had good earnings. It shows you what good earnings can do. Maybe I'll close it on Monday because I made some nice money on it. That's the top 10 groups, folks. And if you saw a lot to buy there, please send me a note because that's top 9. I didn't. Now, longer term bulls would be up for 5 days, and just want to look at some of the midstreams. The challenge here is whether they're capitalized enough to survive. These are like, I don't know what Kramer used to call them, but they're kind of like zombies. These things are barely alive now, but they're seductive because this one pays a 16% dividend. Now, you still need pipelines, you still need oil, gas to go through it. The issue is whether or not they're so leveraged that they can survive our low oil costs that we have today. But if you want to go hunting for some major dividends, 15.9, 18.4 on CNX midstream, 48% on Crestwood. I'm going to go out on a limb and say, I bet they can't make their dividend. Holy shamoli. Cheniere Energy, no dividend. Energy Partners, 11.1. Enterprise, 12.1. These are a story of dividends, and maybe they're getting a bailout too. Unbelievable market. If we go into my buy watch, I did find some things that were interesting. Not all of them are that interesting. So I'm going to go through them because it's short and make comments of things that I might be looking at this weekend or this week and why. Now, again, let me define what I just said. I'm not buying these unless I tell you otherwise. I'm watching these. I'm watching to see if they emerge, if they start to give me favorable patterns. I will look at their charts every night. I will put them into my radar screen in TradeStation, and I will look for exceeded count. I bet that's what it's going to say. I will look for signals occurring during the day. I got too many in. I got to take some out. So I'll be doing various things to look for buy and sell signals occurring on these stocks. I could stick them, and I did stick them, for example, in a market watch group. And I could go to buy watch, and I could look for my same types of signals in here. So that's what I do when I say I make a buy watch list. So Illumina, this is a leader in molecular oncology. Molecular oncology is hot. You've got true bullish convergence and a new buy signal in a bull market. I'd be all over this. It's a leader in its industry. It does make money. It's expensive, although less expensive than it was back here at $400. Down a lot from its high, 52-week high, 36%. I like Illumina. I'd feel better buying it a little higher because I still don't know if it's just going to fail at the 17 and go down. Quality company. Rite Aid, crappy stock. The company's trying to make a rebound. You would think that drugstores are busy now, and they are. So Rite Aid has had some movement. Arrowhead we looked at. I talked about this one a couple weeks ago as one of the alternative energy plays. This is called Clearway Energy Inc. Pays a 4% dividend. It's had a nice move off the bottom. It failed at the 50, but it broke through both its chandelier stop and the 200-day moving average, has a new person buy. And again, another one where lower lows, but bullish convergence on their person market catcher. Coherus Bio, a new buy signal. Why did I buy it? Got earnings per share growth. Why did I buy it? What did I put on my list? No dividend. Vips is a Chinese online play retailer, I believe, flash sales and things like that. It's loosey-goosey. but it had a buy signal sitting on the 50. I mean, I look at this and I see a positive chart. I haven't seen many positive charts. A new buy signal, so it made it to my list. Here's one of those midstreams, 18.4%. Vertex Pharma had been a leader, and up until the last couple of weeks, it sold off. Now, maybe it's sitting at a good buy point. I probably would look at my chandelier stop, and if I can break above this 50, get to 236, which is still a big move here, I might be interested in nibbling. Why would I wait that long? Because odds are it's going to fail before it gets there. Why would I want to buy it and watch it drop? Here's one of these V-shaped recoveries that I'm not sure will hold. I actually have a small, for me, position there. It's a REIT that leases space to pot growers. You can see that it put in a, well, what John would call a jackhammer bottom on the weekly. Ran right up into resistance. This may be like everything else that just dies. It pays a small dividend, or not small, but a dividend of 4.7. Solar Edge, not buying it here. Let me just emphasize, not buying it here. This had been a darling, had a nice run up. Nothing, I'm not sure has changed except oil is now $20, so it's hard to justify perhaps alternative energy. I think when this market stabilizes, this could be something interesting. I put it there to remind me. Atlas Waterworks, I don't even know why this is here. It's clearly under demand. It's got great fundamentals. Off the bottom, but still in a downtrend. One of these, I'm watching it. Oh, I know why. Because it had a bullish convergence on the PMC. That's not enough. It's something. Berry Global, another bounce off the bottom. Cloudflare, an IPO. If this wasn't an IPO, I'd be a lot more excited, but a positive chart, mobile breakout from a squeeze. Gosh, terminology I used to use in a bull market. Here's another one of those marine shippers. These things are failing to get above this. I just want to keep watching them. It's got great fundamentals, 8.5% dividend. Dollar Tree, another one of these V recoveries with resistance and overhead supply. Just watching it. This is a watch list. Unfortunately, these are some of the best things I saw when I went through. Dynatrace, I made money on the upside. It's bounced. It's been up 3 days in a row. I'm going to watch it. Here is a REIT that leases things to the government, so you would think it's got a good paying customer. It's got huge growth, 4.5% dividend, buying it off the 200. Overhead supply, of course, but I feel good about this with the dividend and the fundamentals. Here's another MLP. These are probably zombies, but 33% dividend. Holy shamoles. And then for those that want to buy contra ETFs, I just thought I'd show you a couple of my favorites. This is FAZ. This is a 3-to-1 financial bear. When financials go down, this goes up 3-to-1 based upon the move in the underlyings. This has been a good place to go. I've made a lot of money on FAZ over the last month. It's getting expensive, and if we look to the left, you see why you don't hold these things forever. All right, these things run their course, but for the most part, they're in long-term downtrends. And oh, by the way, take a look at what the prices are on the right-hand side. 330, 400s. Let's just take a look at this peak. This peak is at $6,322. FAZ, and this was in 2011, was never $6,000. But FAZ in these contra ETFs are designed to go down. And there's expenses, and they bet against the market. During short periods of time, they're great, but the way you get to 6,000 is you keep doing reverse splits, reverse splits, reverse splits. They're not buying. They're not long-term buys. They're short-term plays during a tough market. I've been lucky enough to be riding this one. At some point, I will get off. VXX has been the volatility play I've been using, and you could see a nice run up, and it got hurt on Friday with with the market selling off. This should have been back up here to all-time highs, but there was a liquidation event or there's something else going on. How about the Qs? I can go short. I can buy the short triple Qs, which is the SQQQs, and you can see how they've had a nice run up and took out the 200. Better looking than any of the longs I showed you. I could go short the triple Qs, which is, I played the higher price when I went short for a while. And my problem was I cut myself off here. I missed half the move. Dumb. I cut myself off because I bought a put to finance part of the put. I sold a put to finance part of the put that I had bought. I could also look at the SDS. I have a position in that one. Been a nice thing to be long. I could be an SPXS, which is even a triple. Your fund looks the same. I could be short the spiders with put. Lots of different ways to play the bad market. So let me just end in a somber term. Go back to the industry groups. Let's look at 2-day down. 59 groups. Specialty chemicals, medical devices, equity, advertising. Oops, rank them the right way, Jeffrey. Banks, life sciences, telecom, semis, electrical power, entertainment content, medical equipment, communications. A lot of the traditional growth stocks are to the downside. If I look at 5-day down, you have 100 groups. So that just tells you that the momentum is much greater to the downside. So on that note, I think I'm going to call it a day. And just to reiterate my stance, I don't think this is over yet. I think we've got potentially considerable more downside. I hope I'm wrong. I hope I'm going long everything in the world on Wednesday. I personally think that any rallies that we see are going to be bear market rallies, could be ferocious, short-lived, and come back. I will continue on rallies to sell off the FOMO positions I bought and raise more cash because I think I'm going to get to buy things at a 50% off. Why buy them at 35% off? And I also, pay attention to some of those charts I showed you, which suggest it can get much worse. Well, this is probably the most bearish report ever for me, and I hope I'm wrong. The country could use some positivity. You all have a great week, and thank you, and we'll talk to you next week. Bye, everybody.